In this video, I'm going to teach you how to use the Portfolio Builder income platform to generate retirement income for the rest of your life. This is a Google spreadsheet that is unique to your account and is shared and managed by Portfolio Builder. When we create updates to the technology, we can automatically flow this upgrade straight to your spreadsheet. Immediately after ordering your 30-day free trial to Portfolio Builder, this email will show up. Click that icon right there and then click on the star button to bookmark your portfolio. Also, if you ever have trouble finding it, you can go to drive.google.com while signed into your Gmail account. Click on Shared with Me and you'll see the spreadsheet is shared. When the spreadsheet is first sent to you, it will be set with the default settings recommended for the current market cycle. In this case, in entering into 2019, it has a 40% stock position, a 10% cash position, a 10% gold position, and a 40% bond position. With a portion of the target cash position, I'm also investing in digital money assets, which we'll cover later in this video. Because the stock market has been in a bull market for the past decade, and the central banks are beginning to tighten monetary conditions by raising interest rates and pulling liquidity out of the markets, we're in a more defensive stance. If we were in 2008 or 2009 or 2010, after we'd seen a significant crash in equities prices, we would probably be tilting the equity portfolio to a higher percentage and the bond portfolio to a lower percentage. But the decision is totally up to you. If you'd like to have less volatility and still be able to generate consistent income, you might consider a much larger bond position. If you want the highest level of income and you're not worried about your total portfolio's value in terms of volatility, you might want a larger stock portfolio. If you're interested in holding a larger position than 10% in digital money assets, then you might want to consider a larger cash position. And if you already own physical gold, perhaps you don't need the 10% gold ETF position that our portfolio recommends. Once you're happy with the target allocations, the next step is to scroll over to the deposits and withdrawals. And so let's look at a sample portfolio if you were to deposit $100,000. After inputting the $100,000 deposit, I can now scroll over and take a look over here. For generating income, our initial goal is going to be to get at least 100 shares of the SPY ETF, even if that's a greater amount than the Trade Alert first recommends, because we can only write one covered call per 100 shares we own of each underlying asset. So with only a $100,000 deposit and utilizing the current default settings, I may have to skip trades on such as India, Brazil, and the UK in order to get 100 shares of the SPY, Japan, and probably 200 shares of China so that I can have the most possible covered calls written on the largest positions. And so right now the important positions to focus on are the bond position at a 40% target size, the gold position at a 10%, the China position at 10%, and the United States at 16%, with Japan following right after at 4%. So with only $100,000 of capital entering, my first set of trades might be as such, which will be inputted into the stock trade section right here. So what I've done is I've pre-filled out the dark colored shaded cells, which are the only ones you actually use with Portfolio Builder. Anything that's a light colored cell will actually give you an error if you try to type into it, as you can see here. So I've filled in the price, the current market price. I've put in my commission costs. I've said I'm buying it. There's no hold time. The status will be filled. There's no closed profit because we're opening the position. So now I'm going to determine how many shares. So this is trade alerting 333 shares, but I don't need the extra 33 right now. So I'm going to put 300 in. For the SPY ETF, I really want 100 so I can write one covered call each week to generate income. For the GLD position, I need to bump it up to 100. For EWJ, I need to bump it up to 100. And for the MCHI, I need to bump it up to 200. And so we can now see we've spent all of the cash we can spend to buy equities. And we now have a very balanced portfolio. Let's look over here at how close we got. So we have a 36% position in bonds with a 40% target. Our gold position slightly over at 11.8. Our cash position's at 10. And our stock position's at 41. So that's very balanced and optimizes my ability to sell covered calls each week to generate income. Now, with starting at a $100,000 deposit with the default settings, my next goal would be to reaccumulate profits from our underlying assets going up in value or from writing the covered calls each week to generate income, and try to fill in these missing positions because we're missing out on weekly income from Germany, the UK, Brazil, and India currently with this underlying asset. But more importantly, we have the biggest countries covered. And more importantly, you're beginning to understand our goal, which is to accumulate blocks of 100 shares per ETF so we can sell call options against our underlying asset to generate weekly returns. The next step is to wait for the following Monday morning for our trade alerts. And these trade alerts will be primarily geared towards filling out this red section where we're doing open option writing. The plan is every Monday morning, about 30 minutes to an hour after the market opens, you'll be getting trade alerts on which covered call I'm recommending to write against our underlying ETFs. When we first launched the model portfolio, here was the first week of option writing we did on our underlying assets. You can see the return on investment over the period of a week, the credit generated, and the various prices and even the contract name. And as we scroll below, I've clearly shown how to place the trades. This is by far the easiest and safest option trading strategy out there. And that's because we're writing a covered call against an asset we own. If the stock crashes to zero, that's the worst case, and we get to keep the premium we collected. In this case, we're collecting $3.12 right here in the mid price times 2 contracts. Each contract represents 100 shares of the SPY. So that's about $624 for essentially lending our shares of stock to the buyer of this contract. He will only make a profit if the SPY jumps by more than $3 in less than a week. If it does not, and it just goes up $1 or $2, we get to keep all of his money and also enjoy the gain in the SPY. Now, of course, our risk is that if the SPY were to go down in value, we hold on to our SPY contracts. That's a risk we're willing to take with Portfolio Builder because our intention is to hold these positions in these top index ETFs, bonds, and gold for a long period of time. In fact, for the rest of our lifetime. Here's a trade alert on Japan. Same setup. You type in the ticker, sell to open. Your quantity is based upon how many 100 shares you own. So for every 100 shares, you can sell 1. The expiration is always going to be the shortest, which is typically a 1-week option. The strike price will be in the trade alert. If we own the underlying asset, we sell a call option. And if there's a big spread, which there are currently on most of these smaller country ETFs, we do a limit order instead of a market order at the mid price or slightly lower. Now there's higher return on these smaller countries, but there's less liquidity. So that's why we have smaller positions, and thus we take less risk on these more risky underlying ETFs. Germany, same deal, bigger spread, we use a limit order. UK, exact same setup. So let's look at how these get filled into the spreadsheet. So right now we're looking at the open positions in our model portfolio right now. And remember, a weekly coaching call is provided during your 30-day trial and for the first year of your lifetime membership to Portfolio Builder. And again, the dark shaded cells we fill in, the light shaded cells we leave empty. So filling out these trades is quite simple. The date entered goes right here. The expiration date goes right here. The strike price, where we have written an option contract, goes right here. This is the premium we're collecting per share for writing the contract. This is the number of contracts. To get the total credit, this is multiplying by 100. And so we can see now the weekly income we're generating this week. And right here, this is always included in your trade alert. You input that and it will automatically look up your option price. So we want this option price to go to 0, which means we get to collect the full value of the option we wrote. Now at the end of the week, or if something unexpected happens, we might be assigned on our option. If we get assigned or it expires worthless, either way it ends up down here. And it's when closing our position that we realize the commission cost in column O. The option price start, that's how much we collected. If we do decide for some reason to buy back our option, you would input it here, but our strategy does not do that. If you were to choose to do that, you can, and this will calculate your final credit. And in the status, we're keeping track whether did this expire worthless or were we assigned. And if we were assigned, then that means we had to either buy or sell the underlying asset. And so you can see in this example, we were assigned quite a few times on various ETFs, which you'll see actually is a good thing with our strategy and results in generating extra income that week. Don't expect this to happen often. But let's take a look at what happened in the first 2 weeks of launching our model portfolio. So on the first Monday, we purchased our initial stock and wrote covered calls against each position. The next day, we got lucky, an extra $500 of income to collect, and here's what happened. This was the covered call we wrote, which on its own was generating a 1% return on the capital invested to own the SPY shares over a period of 1 week. However, right after we wrote it, the SPY ETF jumped. The person who had bought that call option probably doubled his money. We made a 1% gain in a day. He made a 100% gain. But we utilized $52,000 worth of capital while he only utilized $600. So the following day we issued this trade alert. Now notice this was a put option and not a call option. When we were assigned stock to the purchaser of our put option, we were forced to sell our SPY shares at the agreed strike price. And this in hand gave us $52,500 worth of cash in our portfolio. At this point we had two options. We could simply repurchase the SPY shares and write another covered call, or we can sell to open two 267.50 put option contracts. And in this situation, we get to collect $269 per contract times 2. And if the SPY were to drop below the strike price plus the premium we paid, or rather collected, we would be assigned shares of the SPY. And this actually happened the very next day. And you can see we had a purchase to get our 200 shares of SPY back. So the very next day we had a third source of income on the SPY. We wrote the covered call, which would generate just over 0.5% in 3 trading days by once again lending our shares of SPY until the close of Friday. Now this high level of income is only due to the volatility of the equities market providing extra returns. And you can see in October, November, and December, volatility has been high, making this strategy very effective. In the first week, the strategy collected $3,590 in its hypothetical model portfolio, simply trying to generate a 1% return on average against our underlying assets by writing covered calls. The following Monday, we did it all again. And if we scroll down, we can see the new set of trades. In each update, I clearly explain how I'm moving the open positions that are now expired down to the closed position so that we can then enter into new positions. You can see it's been cleared out here. Push the trades down here so that I can fill in the new trade alerts. And again, we can cover this in your weekly coaching call, but it gets relatively repetitive and easy the more times you do this. And as of recording this video, in the first 2 weeks, the stock and option portfolio is up $7,255 from a $400,000 starting portfolio, with the bonds mostly protecting the portfolio during a very scary market crash. Here's what the stock market has actually done since we launched this strategy on December 10th. Jumped up, crashed down, jumped up, crashed down, flatlining. But thanks to having a defensive stance in a late cycle, you can see our bond position has rose and help protect our portfolio. And you can see the equities are flat, slightly down. The covered call writing has helped protect their losses, while the bond portfolio has appreciated substantially alongside our gold position. Now the next feature I want to show you, which we have not entered any trades in, but we will be shortly, is the open option buying, long open positions and closed positions. This is when volatility drops, we buy long-term crash insurance on our underlying assets. While we can protect against mild market crashes by simply writing covered calls, our biggest fear is the underlying assets drop by 30 to 50% in a short period of time. And this is why we'll be buying leap put options in late cycle to try to catch big crashes in the underlying asset for 5,000 to 10,000% potential gains. And when we look at the big picture, we can see this bull market is clearly running out of steam. We don't know how much longer it will last. But if we maintain a 1 to 3% position buying leap options, which gives us 2 years to catch a crash, really more like 12 to 16 months after we've written the contract. And when we see the VIX volatility drop, that's when I like to buy such crash insurance on each underlying asset. Now, moving along, if we come up and scroll over to the right even more, you can put your starting balance and ending balance at each month, and it will automatically calculate your return on investment in percentage points. If you do want to cash out any of your weekly income so that you can pay for your bills, input it into the withdrawals right here. As you calculate your taxes that are being generated from profits or loss, you can start to input the short-term and long-term capital gains into these two boxes. And this all flows directly into your total value, after-tax profit, return on investment, deposits, and income. Now below this video will be links to understand options in greater detail, as well as a link to go to our very detailed digital money assets tutorials, where you'll get to learn how to build a portfolio that holds these different digital money assets using the same strategy and philosophy. So thanks for your time in this video. Look for our daily trade alerts for actions we're taking in the model portfolio. Don't forget to show up to your weekly coaching session to master the platform and how to use all these different strategies, and continue your education by looking at the links below. Thanks.